Vertice Services presents What is a private limited company by shares? A private company limited by shares is a legal structure, or better, it's an organisation that you can set up to run your business. A limited company has its own rights and duties for everything it does, and its finances are separate from your personal finances. This means that the shareholders' responsibilities for the company are limited to the value of shares that they own but haven't paid for. If the company goes bankrupt, the directors and shareholders aren't responsible for the debts of the company, as long as they haven't broken the law. In order to register a private limited company by shares, you must have at least one director and one shareholder. The director is an office holder and is the individual responsible to try and make the company a success using their skills, experience and judgment. The director can also be an employee working daily in the business, which means he can have a salary. Alternatively, the director could have no salary and work as a non-executive director. The shareholders are the owners of the business holding company shares, and they can cash the business profit money out as dividends, as long as the company has accumulated profits. I'll explain about the distribution later on. A private company limited by shares must have its capital. Its capital could be seen as the total money invested in the company by the shareholders, and the company capital is always divided into company shares. Let me give you an example. A hairdresser called Amina wants to open a hairdresser salon called All You Need Is Love Limited. Let's say, for instance, that the hairdresser wants to invest £10,000 in her business. She can divide £10,000 of investment in 10,000 shares of £1 each. If she doesn't have any partners, she'll hold all the 10,000 shares. So, let me summarise the ways you could cash the money out of a limited company. 1. If you're a director, you could cash the money out as salary. 2. If you're a shareholder, you could cash the money out as dividends. 3. You can also lend money to the company as a loan, and the company needs to pay you back as a loan repayment. 4. You can invest money in the company as capital, but you can only cash the money out eventually when you sell your company shares, partially or totally once you've sold the business to somebody else. A limited company must be registered in Companies House. After 12 months of registration, you must submit your company accounts to Companies House and HMRC. A very simple version of your company profit and loss should be like this. Total sales minus total costs and expenses equals total profit. In the financial year 1920, a private limited company by shares needs to pay corporation tax of 19% of total profit. The corporation tax must be paid 9 months after 1 year. I'm not sure if you understood, but the corporation tax must be paid 21 months after the company was incorporated. Now, the shareholders of the company must make a decision. If the total profit after tax will be kept as retained profit in the company for any possible eventuality or reinvest back into the company, or they can cash the money out as dividends. Let me give you an example. Let's say, for instance, that in her first year trading, All You Need Is Love Limited had total sales of £70,000 and total business costs and expenses of £30,000. The total profit for the year is £40,000. All You Need Is Love Limited will need to pay £7,600 in corporation tax. The total profit after tax is £32,400. Now, Amina, the shareholder of the business, must make a decision if she wants to cash the money out as dividends or keep the money as retained profit. Let's say Amina wants to cash £20,000 to pay her personal bills and wants to keep £12,400 as retained profit. Let me show you the concept of not having mixed personal and company finance responsibilities and duties. Let's see the profit and loss again. From total sales down to retained profit, the money has always been in the company's possession and responsibility. Now, as soon as the total profit after tax is distributed to the shareholder as dividends, the money is in the possession of the shareholder, and this income as dividends will be taxed. Before I go into more detail about dividends taxation, let me explain a little more about dividends. There are 2 kinds of dividends, interim and final. Interim dividends means that you can cash the money out on a monthly basis. Final dividends means that you can cash the money out at the end of the financial year. The shareholder could cash the money out as interim dividends plus final dividends. It's not either one or the other. Coming back from dividends taxation, Amina must declare her dividends in her self-assessment tax return every year and pay tax accordingly. In the financial year 1920, dividends will be taxed as follows. The first £2,000 is tax-free. From £0 to £37,500, you pay 7.5%. From £37,500 to £150,000, you pay 32.5%. More than £150,000, you pay 38.1%. Amina's dividends tax liability will be total dividends cash out of £20,000 minus £2,000 which is tax-free equals £18,000. 7.5% of £18,000 equals £1,350, and that's how much she'll pay. Now, let me give you a few Vertice services tips. 1. Always keep control of your business income and expenses. 2. Please do not submit your accounts delayed. The company will be fined, and it could lastly be struck off from Companies House. 3. The company accounts is not the only document to be submitted to the tax authorities. You also need to submit the confirmation statement to Companies House and corporation tax return to HMRC. 4. Make sure you register your company as an employer, PAYE, to deduct the taxes from your employees. 5. Your company must register for VAT if the turnover reaches £85,000. 6. Be ready for governments making tax digital, with an online bookkeeping solution like the one we provide to our clients, Vertice Plus. It will give you all the information you need to take strategic decisions in real time, and even save you a lot of time and money. 7. Find a very good accountant. Make sure you choose an accountant who has the same goals and values as you have. If you want to grow your business, choose an accountant with a successful track record. In this way, he's the right person to give you advice in how to grow your business. 8. Don't try to be too smart as a director. As I explained to you, you could be disqualified as a director and also criminally prosecuted. 9. Always plan ahead. 10. Enjoy your business journey.